Welcome to the Prime Property Finance Podcast with Gareth Morgan and Mark Watts. This unique podcast will dive deep into all areas of property investing finance, going behind the scenes with property professionals, investors and clients. Between us, we have 35 plus years experience in property finance. The podcast has been launched to share knowledge, mindset requirements and experiences of successful investors and professionals. We aim to simplify many of the complicated areas of finance and investing and provide valuable and easy to implement tips. Keep an eye out for our new longer episodes every Tuesday and our shorter ones every Friday.
One of the biggest reasons property deals fall apart or underperform isn't actually the property itself, it's the finance behind it. Time and time again, we see investors focus heavily on finding the deal, but leave the finance as an afterthought. And that's where mistakes happen. In this episode, I'm going to break down the most common mistakes investors make when it comes to finance, and more importantly, how to avoid them so you can structure your deals properly from day one. Welcome to the latest episode, and good to have you back. Just a quick solo on some of the mistakes that people do when getting finance. But before that, just a quick update of what's been going on our side. Things have been pretty busy over the last couple of weeks. Obviously, with everything going on in the Middle East, it's a bit chaotic. Lenders pulling rates left, right and centre, really frustrating, and obviously rates going up. So it's been quite a challenge for the team to really get on top of that and stay on top of it with emails coming out at 4 o'clock to say that the products are being pulled at 5 o'clock that day. It's not ideal. But hopefully things seem to have settled down a little bit, and we're hoping that the issues won't go on in the market. But, ultimately when there's lots of noise, that means there's opportunities in the market as well, which we'll probably talk about again. But in this episode, we just want to talk about some of those mistakes that we see people making and how you can avoid them. So there's 5 mistakes that we've got for you. So mistake number 1 is leaving finance too late. So this is probably the most common mistake that we see, where, investors find a deal, they then ask, can I fund this? And then, obviously time pressures kick in and then options become limited. Now, there's an old saying in property investing circles that if you've got a deal that's good enough, then you'll be able to finance it, which is true. If the numbers stack, then you will find the finance for it. However, how much time have you got? Always the best deals that need to be snapped up because they are bargains, effectively, don't last on the market for long. So if you don't have your finance lined up, then that can be an issue. And so it depends on your own strategy. Do you have your own cash funds? And if you do have your own cash funds, then that's great. But if you don't, then you need to use investor funds to purchase. You need to use bridging or a mortgage. Not having that stuff lined up, ready to go, is quite difficult, especially as we've seen, the changes in the market over the last couple of months. That has impacted how deals are assessed and the availability of those. So you just got to make sure that, you're not trying to fit finance to the deal. You want to make sure that you've got them both running alongside each other. Finance ultimately should be part of your strategy and not a last minute solution. So yeah, making sure that you've got cash funds ready. If you are using investor funds, making sure that you have those investors lined up. If you have a backup plan, if in case the investor pulls out and you've agreed a deal and you still want to do the deal, it's a good deal, but it won't be around for long. So just having backup plans if investors pull out is always a good one. So, what you need to do is make sure you speak to your broker early, understand what you can borrow on different types of deals. And that's, the knowledge around different types of deals and understanding, especially this one is more important now, is knowing what lender appetite is before you offer on properties. So it's just keeping that constant communication line open, really. Part 2 then is, mistake 2 rather, is chasing the cheapest rate. This one sounds sensible, but often it isn't. And what a lot of people do is they compare the headline rates and they always want the cheapest option. And we've spoken about this a lot in the past, and cheapest isn't always the best. Just because someone's got the cheapest rate, generally the cheapest rates are reserved for more what we would call vanilla type deals. So very little risk, straightforward criteria, no issues, very little flexibility. Also usually aren't the fastest in the market. because obviously it's more of a volume-based lender when they've got the best rates. So, generally the majority of the deals that we see, are very few of them are vanilla, where there's nothing wrong with them at all. So it also depends what deposit you have. So cheapest rate isn't always the best. Of course, that our job is to get you the cheapest rate, but also our job is to get you the deal as well. And sometimes through experience, we'll know that the cheapest we would avoid purely because of certain criteria. If you need speed and that's a must, then we would sometimes avoid some of the cheaper lenders purely because we know that these other people will get the job done no matter what. So it's around what's more suitable for a specific deal that you have at hand. So cheapest is good, obviously ideal, but it's not always the best. And ultimately, when we say that could lead to expensive mistakes. So whilst it's cheapest on the foreside, if you end up losing the deal because your lenders let you down because of the time it takes, for instance, then that all of a sudden it doesn't just become the cheapest deal. It becomes very expensive if you miss out on the deal where you could have just gone to the second or third cheapest lender, which would have got the deal over the line. So mistake number 3 is not thinking about the exit. Obviously, this is more focused on bridging finance, around where people focus on getting the loan, but they're not sure how they'll repay it. So for bridging finance, development finance, or refurbs that we fund a lot of through different development finance deals or bridging finance, our job is making sure that you've got the exit lined up. Obviously, you've always got the optional exit of a sale, but in a difficult market, that isn't always the case either. So it's just thinking about those exits early on. We always make sure that whenever anybody gets into a bridge or development finance, that they have a number of options for the exit. What we do see a lot of is people coming to us on a bridge and they haven't considered the nuances or the complexities of being able to get a refinance. And that does cause us some headaches. So just really want to make sure people are thinking about that. On any of these short-term loans, the most important part of it is not how you get into it, it's how you get out of it and make sure you can get off that loan. So really being clear on the exit strategy. Mistake number 4 is over-leveraging. So this is maximizing borrowing, squeezing every last penny out of deals. If you've got access to 50K, 100K, 500K, and what we see is that people will, let's say they've got 100K, they will use as much of the funds as they can into the deposit, and then they'll leave very little, they'll just have enough to maximize the deposit, the fees, stamp duty, etc. But will leave themselves with no wriggle room and no cash in the bank. And then that really stifles deals, because if things go wrong, valuations drop, rates increase, rents don't come back as planned, delays, holding costs, refurbs going over, which is obviously the big one. So all of those, if you don't have any buffer in cash, then that can cause you problems as well. So just because you can borrow more, it doesn't always mean you should. And then more on your portfolio, a lot of people will maximize their leverage on their portfolio to 75%, some cases 80% if they can, to really squeeze that. But that doesn't allow any huge moves in the market. So for instance, if there's a 10, 15% drop in the market and you've leveraged up to the max, then that doesn't leave you much wriggle room if you need to get out for whatever reason. So in terms of long-term hold, the average we see probably across portfolios is about 60% loan to value with more mature investors. Obviously, in your early years, you want to be at a higher loan to value to maximize the momentum within your portfolio so that you can keep buying more and grow your portfolio, if, of course, that's what your plan is. So, ultimately, you want to be maintaining buffer, building resilience into deals and thinking long-term and not just in the short-term acquisition. Finally, then we're on to mistake number 5, which is not reviewing existing finance. This is huge from a portfolio landlord perspective. You can get the rates, you lock in for 2 years, 3 years, 5 years, and then you don't really look at it. So many landlords we see, surprisingly, just are sitting on standard variable rates or on trackers, long-term trackers that are quite high. So when rates mature, products expire, is that, you should be looking at those regularly, because, we've done a couple of deals recently where we've saved investors thousands of pounds purely on just switching them onto new deals on their existing portfolio. So again, there's so many landlords out there who aren't on top of this, keeping on top of their costs and their mortgages, and ultimately leaving money on the table. Because if you've got a large portfolio and you've got 4 or 5 different properties on there that you haven't reviewed, then that could be cost you thousands of pounds. And ultimately, that's all bottom line. And in an environment where costs are going up all the time and everything's getting squeezed, all of those additional pounds will make a huge difference to your overall profit on your portfolio. Ultimately, your portfolio doesn't stand still, and neither should your finance. So just keep on top of it, keep checking it, regularly review your portfolio, track your expiry dates, and reassess that structure over time. If you want to have a chat with us to review your portfolio, then please get in touch, and we'd be more than happy to sit down and go over that with you. So, what does good look like, and how can you avoid these mistakes? So, just a quick recap is plan your finance before you buy in, making sure you've got some backup options. Focus on the best product, not the cheapest product. Making sure you understand your exit. Maintain some cash buffer, and regularly review your portfolio. Good investors don't just find deals, they structure them properly. So, look, thanks for listening. In closing, finance isn't the most exciting part of property investing, but it is one of the most important. Getting it right can be the difference between a deal that works and one that creates you stress and costs you money. If you're currently looking at a deal or even just reviewing your existing portfolio, it's worth stepping back and asking, is the finance structure actually supporting what I'm trying to achieve? Thanks for listening, and we'll see you on the next episode.
Thank you so much for listening to our podcast. We hope you have learned something and have some tips to take away. We'd be very grateful if you enjoyed the show. You could give us a review and share with anyone that you know that may be interested. And of course, subscribe to the show so you can get notified when a new episode is released. If you'd like us to answer any questions or go deeper on a specific topic, please drop us a message at primeproperty.finance. See you on the next episode.